The fifth learning objective is to calculate the break-even point for multiple product lines or services. Absorption costing primarily differs from variable costing in that absorption costing considers fixed manufacturing costs as inventoriable product costs, not as period costs. Exhibit 19A1 summarizes the difference between absorption and variable costing. Chapter 19 Summary. Variable costs are those costs that increase or decrease in total as the volume of activity increases or decreases. Fixed costs are costs that do not change over wide ranges of volume. Costs that have both variable and fixed components are called mixed costs. The high-low method is an easy way to separate mixed costs into variable and fixed components by requiring you to identify the highest and lowest levels of activity over a period of time. The relevant range is the range of activity where total fixed costs stay the same and variable costs per unit stays the same. The break-even point in the sales level at which operating income is zero, total revenues equal total costs. The break-even point can be found by using the income statement approach, using zero for operating income. The break-even point can also be found by dividing total fixed costs by the contribution margin per unit. That's sales price per unit minus variable cost per unit. Break-even analysis can be used to calculate the sales volume needed to earn a certain amount of profit, called target profit. Target profit is the operating income that results when sales revenue minus variable costs and minus fixed costs equals management's profit goal. Graphing various activity levels and costs give a visual presentation of operating levels that generate net income and operating levels that result in net loss. Sensitivity analysis is what-if technique that asks what results are likely if selling price or cost change if an underlying assumption changes. The income statement approach to break-even is just adjusted for the new proposed values. The margin of safety is the cushion or drop in sales that the company can absorb before incurring a loss. Most companies sell more than one product. Selling price and variable costs differ for each product, so each product makes a different contribution margin to profits. To calculate break-even for each product, we compute the weighted average contribution margin of all the company's products. The combination of products that make up total sales, called the sales mix or product mix, provides the weights that make up total product sales. Variable costing assigns only variable manufacturing costs to products. Fixed manufacturing costs are considered period costs and are expensed immediately because the company incurs these fixed costs whether or not it produces any products or services. In variable costing, fixed manufacturing costs are not treated as product costs. Management accountants often prefer variable costing because contribution margin is readily apparent on the variable costing income statement.